This week on the Wall Street Report, concerns are swirling that the Federal Reserve's policies are causing investors to take on added risk that could destabilize markets. We check in with an expert who called the financial crash and the stock market bubble of 2000 to see what he's seeing now. Are emerging market bonds still a good place to find yield? Plus, is the luxury market back in the U.S.? Two retail gurus square off.
Hi, everybody, and welcome to the Wall Street Report. I'm Jennifer Schonberger. Federal Reserve Chairman Ben Bernanke says the central bank is sticking to its easy money policies, putting to rest concerns the Fed could wind down its quantitative easing program earlier than thought. The Fed is staying the course despite a handful of skeptics within the central bank and a growing chorus of money managers who believe quantitative easing and zero interest rates are pushing investors into riskier investments that could eventually destabilize the financial system. Bernanke says the benefits of continuing QE outweigh the costs. Then again, Bernanke also testified in front of Congress in 2006 that subprime was contained. You know the rest of that story. Skeptics are right to sound alarm bells. While the Fed's policies are helping the housing market recover and haven't yet spawned inflation as many have feared, easy money policies have fueled bubbles in different pockets of the markets. For starters, the policies are driving investors into riskier assets to find yield. Issuance of high-yield bonds is at record levels, even as yields are at record lows. Translation, investors are willing to take on more risk from less credit-worthy companies because those securities offer a greater yield than U.S. Treasuries. Low interest rates are causing pension funds to fall short of meeting investment goals for retirees. The result? Pension funds are taking on riskier trades, borrowing money to invest in bonds to boost returns, the very strategy that contributed to the global debt bubble and led in part to the financial crisis. In a different corner of the market, investors have poured $400 billion into mortgage real estate investment trusts. That's up from $15 billion in 2000. If interest rates go up, investors will lose money, and it could cause repercussions for the mortgage market. There's also a great risk that quantitative easing is becoming a permanent crutch for the economy, and that the Fed is trapped at zero interest rates. Japan is the precedent. After a major property bubble burst more than 2 decades ago, the island nation embarked on quantitative easing to juice its economy. Japan has been stuck in an economic malaise with falling prices ever since. It's time for the Fed to stop blowing bubbles and prepare markets for its exit strategy. The Fed has no experience doing this, and an exit will likely result in upsetting markets to a degree. But the risk of never unwinding could be greater. Need I mention Financial Crisis Part 2 or Japan again?